The US dollar just hit its highest level in over a year, and if you think that doesn't affect you, think again. The dollar index, which measures the dollar's strength against a basket of major world currencies, climbed to 100.7 this week, its highest point since May of last year. And the reason is one that should concern every American with debt, a mortgage, or a retirement account. Markets are now pricing in a real possibility that the Federal Reserve will raise interest rates before the end of 2026. In the next 10 minutes, I'm going to break down exactly what a surging dollar means for your purchasing power, your investments, and the prices you pay for everything from electronics to groceries, and why this dollar move is signaling something bigger about where the economy is headed. A rising dollar sounds like good news, more powerful American money, right? The reality is far more complicated. Let's start with the basics. The dollar index measures the greenback against 6 major currencies: the euro, the Japanese yen, the British pound, the Canadian dollar, the Swedish krona, and the Swiss franc. When the dollar index rises, it means the dollar is buying more of those currencies. This week, the dollar surged because of one reason above all else. The Federal Reserve signaled that interest rates could go higher. New Fed Chair Kevin Warsh held rates steady last week, but his tone was unmistakably hawkish. 9 of the 18 Fed policymakers now project at least one rate hike before the end of 2026. The message to global investors was clear: park your money in dollars because American interest rates are going up. When rates go up, money flows into dollars. Investors sell other currencies, buy dollars, and invest in dollar-denominated assets to capture those higher returns. The result: a stronger dollar. Now, here's where it gets complicated for the average American. A stronger dollar has real winners and real losers. The winners: Americans traveling abroad. Your vacation to Europe, Japan, or Canada just got cheaper. Your dollar goes further. Americans buying imported goods also benefit, at least temporarily. Electronics, clothing, cars made in Europe or Asia become relatively cheaper when the dollar is strong. But here are the losers, and there are more of them. American exporters get hammered when the dollar is strong. Companies like Boeing, Apple, and Caterpillar, which sell products overseas, earn revenue in foreign currencies. When they convert that revenue back into strong dollars, they get less. That hurts earnings, and it hurts stock prices. Emerging market countries that borrowed in dollars get crushed. They borrowed in a cheaper dollar. Now they have to repay in a stronger one. Countries like Brazil, Turkey, and Argentina are already feeling pressure. Commodity prices denominated in dollars also fall. Oil, gold, soybeans, they all become more expensive in local currencies, which reduces global demand. And perhaps most importantly for Americans, a strong dollar exports America's inflation problem to the rest of the world, while keeping domestic inflation elevated because it doesn't reduce the cost of services, which is now the main driver of American inflation. Let me translate this into what it means for your wallet specifically. If you have credit card debt, auto loans, or a variable rate mortgage, higher interest rates hurt you directly. The Fed's signaling rate hikes pushes short-term borrowing costs higher. Your credit card's interest rate is tied to the prime rate, which follows the Fed funds rate. If you're invested in the stock market, a strong dollar environment is historically mixed. Domestic companies focused on the U.S. market can do okay, but multinationals, which make up a huge portion of the S&P 500, face earnings headwinds from currency translation. If you're planning to buy a home, watch mortgage rates closely. They've been stuck above 7% all year. A Fed rate hike won't directly raise fixed mortgage rates. Those track 10-year Treasury yields. But if the Fed raises rates aggressively, it could signal that inflation is staying elevated longer, which would push long-term yields higher and mortgage rates with them. Wall Street is paying close attention to what happens next. The key event is Thursday's inflation report. The PCE price index, the Fed's preferred inflation gauge, is expected to show prices still running above 3%. If the number comes in hotter than expected, the case for a September rate hike becomes almost certain, and the dollar will surge even further. If inflation surprises to the downside, if prices are cooling faster than expected, the dollar could give back some of these gains, and rate hike expectations would ease. This is the razor's edge the Fed is walking right now. Too hawkish and they risk a recession. Too dovish and inflation stays stuck. For now, the dollar is telling you which way the smart money is betting. Rates are going up, the Fed is serious about fighting inflation, and the easy money era is over. Whether you're ready for that or not, your wallet is already reacting. Subscribe for daily coverage of the economic moves that affect your money. We post every single day so you're always ahead of the headlines. I'll see you in the next one.